Risky Options Trading by www.options-trading-education.com. With a sound options trading strategy, one can make a lot of money. But there is safe options trading and risky options trading. In our view, buying calls or a combination of puts and calls can be profitable and not all that risky. Risky options trading is when you only sell options. The one exception is selling calls on stocks that you already own. Here are a few thoughts about safe versus risky options trading. When selling calls is profitable. Selling calls on a stock that you own guarantees you the current price of the stock and the premium paid by the buyer. The problem is that the buyer will only purchase the stock if the price goes up, in which case you will wish that you had not sold the call contract. This strategy works in a cyclical market. Sell the call at the top of the cycle, and it is unlikely that the price will rise sufficiently for the buyer to execute his contract. It is a common practice for smart investors to profit from selling calls when they believe that the stock has come to its peak. A person who has owned a stock for a long time and is thoroughly familiar with the fundamentals and technical factors that drive its price can often profit from selling calls because his knowledge of the stock is far superior to that of the buyer. Risky options trading. Over the long run, and including all options trades, selling options is more profitable than buying them. This is obvious because options writers only set a price that is more likely to be profitable for them than for the buyer. The risk of selling an option is that you give the buyer control over when to execute the contract. If, for example, you have sold a put on a stock and the stock price plummets unexpectedly, you may find yourself needing to pay a large multiple of the new price simply to buy the stock at the contract price and then sell for a loss. Those trades who use options trading leverage to magnify their profits are at an increased risk in this scenario, as they may well be in for a margin call, having exhausted their currency reserves in a single bad trade. This is the gist of risky options trading in selling either calls or puts. Hedging the risk. One way to hedge risk in otherwise risky options trading is to mix sells and buys. There are various ways to do this, and trading software that will help you make the calculations. The point is that there are always temporary inefficiencies in the market, and you never have to wait until the buyer acts before getting out of an options trade. One can execute the opposite trade, buy for a sell, and limit trading losses in even the most risky options trading. The worst losses in selling options contracts are when traders lose contact with the market for an extended period of time when there are chancy trades on the table. If you are losing money in a trade, get out. Options trading is not gambling, and you can cut your losses and trade another day. Learn more about options trading at www.options-trading-education.com.